By the end of this video, you will learn the roadmap to become a day trader as a complete beginner. This is a full course going over everything I've learned in the last 7 years and has more value than courses charging hundreds, if not thousands of dollars for the same information. I'm going to share exactly how I would start day trading all over again if I had to start from scratch. From what is day trading, how to read candlesticks, which trading platforms to use, which strategies are the best, how to master your psychology, and much more. This video will help you to finally become a day trader the right way. So if you're ready to become a day trader, make sure to subscribe to the channel, like this video, and let's get into it. So in this video, I'm going to break down exactly how to start day trading as a complete beginner. This will be a full in-depth course to give you the roadmap to start trading the right way. And by the end of the video, the goal is that you will go from beginner to actually understanding exactly what to do to become a day trader. So as you start trading, this is going to be the biggest question. What is the actual goal of trading? What do we actually want to accomplish as a day trader? A lot of people have a misconception about day trading, and that's exactly why I want to make sure you're on the right path. Trading is not a get-rich-quick business. In fact, trading is a very slow journey. Social media portrays trading and glamorizes it, but in fact, trading is extremely boring, and you need to have patience to see consistency. Along with this, trading is not gambling. Traders who have seen consistency and profitability, they don't gamble on their trades. Instead, they have a systematic approach that they come in with every single day, and all they have to do is execute. Finally, trading is not for those who want a guarantee. There is nothing in trading that is certain. As a trader, what you need to understand is we play with probabilities. Our only goal is to make sure that the probabilities are in our favor. That is the only thing that we can do to have more of an edge in the market. And in this video, I'm going to explain my simple method on how I approach trading. However, it is extremely important to remember that nothing with trading is guaranteed, similar to a business. For me personally, it took me 3 years of consistently losing money to start seeing any results from trading. Now, the reason I'm emphasizing it took me 3 years of losing to see results is because there's so many videos online now that make trading look so easy. And if you follow one thing, you'll become profitable. But in reality, we can make trading simple. And in this video, I'm going to share with you exactly how I've been able to simplify my trading approach. That doesn't mean that you won't have to put in the hard work required to see the results you're looking for. I want to make sure that I start your journey the right way. Nobody else will tell you that it actually takes time to become profitable. It will take hard work and learning the right systems. And in this video, I'm going to share the exact system that I trade that's helped me trade full time for the last 7 years. So now that we have the right expectations on how to start day trading, if I show you this chart and you're confused, don't worry, I will simplify everything down for you, along with teaching you the strategies that I use to really trade. But what does this chart overall show? As a new trader, you should be able to identify that the chart is indeed going to the upside. We of course had some pullbacks along the way, but overall this chart is indeed in an uptrend. So if we know if a chart is in an uptrend, what is actually moving the stock's price to the upside? Well, the only thing that will move a stock's price is going to be buyers and sellers. So every single time we pulled back here into an area of demand only to shoot back to the upside, this was buyers bringing it up. So you can see here, once again, buyers stepping up every single time we pulled back. Vice versa, every time we came up into a top, this is where the sellers were sitting. So you can see, similar to buyers, sellers are also sitting at every single high that the stock is making. So you need to understand the way the stock moves is the interaction between buyers and sellers on the actual price of the stock. Later on in this video, I'm going to go much more into detail on exactly how the stock price moves and how we can enter in to really capture these moves. But I want to make sure that this helps you see the chart in a different perspective. So if we talk about the goal of trading, we know that buyers are sitting every time we come near these demand areas or these pullback areas. Vice versa, we know sellers are sitting every time we come near this resistance or supply area. So the goal for us is to buy in these areas where the stock is pulling back and we know buyers are going to step up, and it is to sell in the areas where we know sellers are going to be approaching the markets. In this example, if we bought when the stock price was $100 and we sold when the stock price was $200, that means we would capture the full $100 move of the stock. So we would capitalize from where we bought the stock to where we sold the stock. I want to make this very clear so you understand how much profit and loss you're going to have on a trade. All you have to do, you take the quantity of how much you bought or sold and you multiply it by the selling price and then subtract that from the quantity multiplied by the buying price. So if we take our example from previous and assume that we bought a quantity size of 10 shares, well, you can see we bought 10 shares multiplied by 200, subtract 10 shares multiplied by the $100 buying price. Therefore, the total profit that we would make on this trade is $1,000 if we simply entered when the stock price was at 100 and sold when the stock price was at $200. So just to make sure you understand this concept, based off what we said, we know that this is going to be an area of demand because this is where buyers initially stepped in, and we know this is going to be an area of resistance or supply because we know this is where sellers stepped in to bring the stock back down. Therefore, we understand to capitalize on this move, we need to look for a low risk entry near the support level for the move back to the upside into this resistance area. So if we play out this trade, you can see when we came into this area, we had buyers stepping in. Once again, if you don't understand candlesticks and price action just yet, don't worry. But now as a trader, to capitalize, all we would do is have our stop loss right below the support or demand level, and we would have our profit target where we know the sellers are previously sitting, which is this resistance / supply. Now, this is where we would enter into the trade, and let's see exactly what would happen. So we had a very nice move back to the upside based off of that previous equation plus how much the stock moved up. This resulted in a $3,170 trade by understanding we capitalize on these short-term movements as a day trader. So now that we understand how to capitalize on these moves as a trader, what are the tools you need to start trading? And unlike you think, you don't need this whole Wall Street setup to start trading with 100 different screens, monitors, big fancy PC setup. Instead, to start trading, all you need is a broker and a charting software. Now, for myself personally, I use TradingView to look at the charts and view the markets, and I use interactive brokers to actually execute the trades that I'm looking at on TradingView. Now, just because I use that doesn't mean you need to. There's a lot of different options when it comes to choosing a broker or a charting platform. The charting software for most people will mostly stay the same, and that'll just be TradingView. But if you're trading crypto, Forex, futures, stocks, options, there's a lot of different ways to go about it. Now for crypto, all I will say is be safe when you're choosing an option. Binance and Coinbase are the biggest and safest, but once again, make sure to do your own due diligence. Another way people trade are prop firms. Now all prop firms is they require less capital up front. So with the prop firm, you could manage a $100,000 account for an initiation fee of $20. And this is why for new traders prefer going the prop firm route, just because it requires less capital up front. For myself personally, I didn't use prop firms. However, I know a lot of traders do. There's a lot of different prop firms out there that you can choose from. Apex Trader has been around the longest. It's also had some of the biggest payouts, so you know they'll pay you out if you do reach your goals. And finally, brokers. There's a lot of different brokers to choose from as well. For futures, stocks, and options, you have Webull, Thinkorswim, Robinhood, which a lot of new traders use just because of the clean and simple interface, and interactive brokers. And of course, that's the one that I use personally. So there's a lot of different platforms to choose from, but now let me explain exactly how I have my platform set up, how I enter trades, how I exit trades, and I'll show you a live example of me actually placing a trade so you can see exactly how to execute. So the first thing you're going to do is go on TradingView. This is going to be your charting platform that you can start for absolutely free. Once again, for anything that I talk about in this video, all the links will be in the description, but all you do is either come up here and click get started or this button right here, and then you create your account. Now, once you log in, you'll see this screen. All you have to do now is click the products up here and click super charts. This will bring us to the actual stocks that we want to see. And here we can now search up any name that we want to trade. So for example, if we want to trade Tesla, all we have to do is type in TSLA. We can click it and then it will bring us to the chart and we can view it in real time. Now, the next thing we're going to do is come over to Interactive Brokers and we're going to download the desktop version for Interactive Brokers. So once we have the IBKR downloaded, this is how it's going to look. On the right side here, this is going to be the options chain. So if we're trading options, we're going to see all the different option contracts here, along with when they expire, along with their date as well up here. What we want to focus on and what I trade is always going to be first option contract out of the money. Out of the money simply refers to the first black shaded contract price that you see. So when we're buying calls, we're looking for the stock to move up in price. And you can see the first black shaded price is 212.50s. So that's what we would be buying if we were looking for the stock to go up. Vice versa, if we're looking for the stock to go down, we're going to buy the first black shaded one, and that's going to be the 210 puts. That means we're looking for the stock to go down. Now, on top of this, on the left side here, this is where you can focus in on the names that you're looking for. So let's assume I wanted to take the 210 puts. All I have to do is click this and drag it over here, and this will give me the exact contracts that I want to look for. And now, rather than looking at all of this, I can simplify my watch list for the day because I'll already have the names that I'm looking at over here. From here, all I have to do is click the name here, and then it'll pop up in my order entry. I can change the quantity of how much option contracts I want to buy. And of course, the option quantity depends on the risk that you're comfortable with. And then all I have to click is submit, and my order will pop up on the right side here. Let's see a live example of exactly how this works. So let me simplify this completely. If we want to buy puts, all I have to do is move the 207.50 puts over. Then if I actually want to enter into the puts, I simply just have to click on the option contract I want to buy. You can see it pops up over on the left side of the screen. I put in the amount I want to buy and then click buy market. Now you can see it's actually on the right side of my screen here. You can see the order, it went through, and I can see I bought it as well. Now to sell it, all I have to do is simply click sell market, which is this red button right here. And just like that, you can see I sold that one put. You can see we're in a realized profit about $9, and that's exactly how I execute my trades. So now that I've explained exactly what trading is and how to execute trades, let's talk about how to read candlesticks. This is going to be extremely important because you need to understand how to read where buyers and sellers are interacting, and we do this through candlesticks. So I'm going to simplify exactly how I read candlesticks and what to look for. To read the charts like a profitable trader, we need to know how to read candlesticks first. So let's talk about how candlesticks actually form. Now, candlesticks are the basis of trading because you need to understand candlesticks is what's going to give you the information to actually trade. On the left side here, we have a bullish candlestick, and on the right side, we have a bearish candlestick. All that means is this candlestick, when it's bullish, the stock is projected to go up, and when this is bearish and it's a red candlestick, the stock is projected to go down. We have the open of the green candlestick right here, and this is going to be at the low of the body. So this shaded area of green that you see, this is called the body, and the black lines are called the wick, and this part right here that's shaded is called the body. What does this mean? This shows us that the candle opened up here and made this low. When it makes a low, all this is telling you is that sellers came in and actually moved the candlestick down. This shows that at this area, sellers were more stronger than buyers. However, the candlestick went back up to the high up here, and this means that the buyers were stronger than sellers, and this shows that this stock is projected to move back to the upside. And finally, we made this wick, which once again shows that sellers try to bring the stock back down, but when we close the candlestick right here, the close of the candlestick simply means that at whatever time frame candle this is, may it be a 1 minute candle, may it be a 4 hour candle, when the candle closes, it shows shows you where the most activity is. And the most activity will occur in the body. So right here is where the most volume was traded within that candle. And because of this, we know that the candle opened here, closed here, and the body is green. And therefore, this is going to be a bullish candle, showing that buyers were a little bit more aggressive, and we should be looking to go potentially long on a trade to the upside. On the right-hand side, we see a bearish candlestick. What does this mean? Well, for the bearish candlestick, as you can see, we open up near the top of the body. And this is because this candlestick once again moved up to this high, showing that buyers were stepping in when we opened up and they were overpowering sellers. However, we then moved all the way back to the low of the candle. When we move to the low of the candle, that once again shows us that sellers are overpowering buyers again in this area. And finally, when we close this candlestick, what does this tell us? We closed below the open. And therefore, whenever you see a bearish candle, that is an indication that you could potentially go short on the trade. However, of course, just using candlesticks is not going to be enough for you to actually enter into profitable trades. And we'll talk about the full system. However, you need to know how to be able to read candlesticks for you to use the system. So in the most simple ways, when the stock opens up and closes above its open, that's going to be bullish and a bullish candlestick, which is green. And when it opens and closes below the open, that's going to be a bearish candle, and that's going to be red. Now, with this being said, there is a lot of different types of candlesticks. Quite frankly, I know all of them. However, I really don't need to know all of them. I don't even know why I know all of them. I don't use all of them. I can simply read price action. However, every single candlestick is going to tell you a different story. In this candlestick right here, this is a shaved bottom. This means this open was the same as the low. So here we can see the open, and then this open, we never had that wick. Remember I told you about those lines. We never got that line. Actually, we just ended up moving back to the upside and the candle closed right here. This shows that sellers were never present on this candle near the low, and they were only present near this upper wick, which shows that buyers were stepping in all throughout this body, and this is going to be a bullish candle. Now, the same thing can be said here, but this is going to be a little bit different of a candlestick. This is the shaved head. What does this mean? Well, we actually opened up because this is a green candle, so the open is always going to be at the low of the body. We open up right here, we brought it down. However, buyers brought it right back up and there was no wick, which means that for this specific candle, this is an extremely bullish candle where we could look for, once again, that long position. Now, this is going to be a gravestone candle. The reason this is called a gravestone candle is because similar to a gravestone, which indicates the end of times, this most likely indicates the end of a trend or a reversal coming soon. In this candle right here, we can see that the open, low, and close is all the same. So we open the candle here. You can barely see a body because there's not really a body here. We move the candle to the high up here, meaning at one point, this was a full green candle, just like this one over here. However, sellers brought it all the way back down, which means that sellers are overpowering buyers in this gravestone area. And if we had an uptrend, this is usually the indication that the stock is going to move back to the downside. Here we have a close cut candle. This means the open is the same as a low and close is the same as the high. So there's no wick on this candle, right? We can see that this is only simply body, and therefore we open up right here, we close up here, and the full candle is simply a body candle. Now, this is going to be the big green candle. This is what everyone knows, and whenever you see stocks, this is usually the candle that it's represented. This is the candle we just went over as well, so I don't have to go through this candle. This is going to be the bullish one. This is the big red candle. This is going to be the bearish one. And then we have the dragonfly doji. Now, the dragonfly doji is very similar to the gravestone. However, rather than the gravestone where we were actually moving to the downside, the open, high, and close is all the same. So here you can see the open, low, and close is the same, but here the open, high, and close is the same, meaning that we opened up here, sellers try to bring the stock back down, but buyers brought it right back up. And this is once again another bullish candle. So There is a lot of different ways to look at these candlesticks. And as we can see so far, every single candlestick gives us a different indication on what it does. The hanging man, for example, the high is the same as the close with a long lower wick. So here, once again, we open up right here, we bring the stock down with this low, and then buyers bring it right back up, which means that we close at the high, and this is going to be another bullish candle. This is the doji candle. Now, the doji candle is important to understand because on the doji, we can see we open up the stock right here, we move to the upside, and we also move to the downside, but price closes at the exact same open level that we were already at. And therefore, this shows that both buyers and sellers are equal. There is nobody that has more strength or weakness. This simply shows that price is fair, and both buyers and sellers believe price is at a fair cost. The hammer stick candle is one of my favorites. The way the hammer stick candle works is we open up right here. We have sellers coming in showing that they want to move the stock back to the downside. But because we close back at that high, this shows that buyers stepped in. And usually for me, I always like to enter in on hammer stick candles. The way it works is, let's say if we had a level right here, which we'll talk about how to get those proper key levels as well. But if we had a key level right here, and let's say the stock was moving down and then it wicked below this key level, well, this wick most likely got rid of a lot of retail traders. And if we enter into this position, it will most likely move back to the upside, and all we had to risk was simply the close of that low. But if that doesn't make sense to you just yet, it will when we go back into the examples. The inverted hammer is the exact opposite. This is going to be, let's say we're in a downtrend, we have a retest level right here. If we come back into this retest level, however, we have a wick above this level, this is going to show that once again, sellers got closed out right here or stopped out, and then we go short on the trade because most retail sellers got stopped out, and we make a move to the downside. Finally, the spinning top, the same difference between open, close, low, and high. So as we can see, this is a very symmetrical candle. We have the open right here, we have the close right here. However, the high of the wick and the low of the wick down here is all the exact same level. So for the spinning top candle, once again, similar to the doji candle, this really does show that buyers and sellers are equal, though this is a green candle, so you can indicate maybe buyers are a little bit stronger than sellers, but for the most part, this candle also shows that buyers and sellers are equal. Now, here we have the bullish candles and we have the bearish candles as well. We already talked about how these candles form, but like I said, for me, my favorite bullish candles are always going to be the hammer stick candle, the full body bullish candle, of course, as well. And sometimes I may enter in just simply on a normal candle, but these last two are not as bullish for me. Now, same thing for bearish candles. If I'm going short on a trade, I would like to enter in on either a full body candle closure below a key level, or once again, that kind of gravestone candle for a move back down to the downside. These are going to be my four most favorite candles. Of course, the top is going to be if I'm going to go long on a position, and the bottom is going to be if I want to go short on a position. Well, we can see right here that Google example came back into where an area of support. We can see this key level right here. This was an area of support. We'll talk about how to get areas of support as well. And what happened? Well, we had a very strong candle. We got a wick below the key level, and then we got an extremely strong body candle closure to the upside. And because of this, what did it show? Well, we actually opened the candle here, moved to the downside, closed at the high of the candle. Therefore, we would enter into this position simply risking the close below the low of the candle. And as we can see, if our profit target was even high of day, we got to that level, but we also surpassed it by a big amount by simply understanding how those candles form. Now, after candlesticks, the next step is to master market structure. Though you understand how buyers and sellers are interacting with each other, now you need to understand where they will interact with each other, and this will help you have much better profit targets. It will help you have a much more clear stop loss area, along with more precise trades where you don't get faked out or manipulated by the trade. So let's talk about exactly how to read market structure like a pro. The first thing we have to understand is the basic foundation that creates market structure. The three ways a market moves is going to be an uptrend, consolidation, or downtrend. Now, if you think this is a little bit too basic for you, don't worry, this video will go over the advanced market structure as well, but I want to keep it as simple as possible and make sure we all start from the same foundation. So for an uptrend, all we're looking for is a low to be created and then a high. After this high is created, when we come back for a pullback, our next low has to be higher than our previous low. And as we move up in this uptrend, this is the pattern that has to continue. As we can see, this is a higher high from this previous high. And then of course, when we come back for the pullback, this low must be higher than the previous higher low. In this example, we can see that this uptrend simply continues. And this, in the most basic way, is how we're looking for an uptrend. Now, if you've watched my videos before, you know that I am a big advocate of trading the uptrend and the downtrend. However, I personally will try to sit out of consolidation or sideways action. We get sideways action when the market is in range or when buyers believe that the price is fair. So in this example, when we see this sideways or consolidation action where we see the exact same equal highs on the stock, but at the same time we see the exact same lows, this tells me that we're going to chop around, and this is going to be a lower probability day to trade, especially if you trade momentum who likes their trade to work out quickly. Therefore, I tend to avoid this consolidation action, and I much rather wait until we get a break of one side, the retest, and then the move down, because this move will work much faster and it will be a much cleaner move than this whole sideways action. And finally, of course, we have the downtrend. In the downtrend, we have a high. Once we create a low, the exact opposite of a downtrend, we come back for a lower high, and this high must be below this previous high. And of course, the downtrend does the exact opposite of what an uptrend does. So in the most basic ways, this is the only three ways that a market can move. Now, once you understand that, all of a sudden you're looking at different market structure and you understand what's going on. However, in the real world, we don't get textbook examples. With real trades, this is most likely what you're going to see. In this example here, we have a high, and then we have a higher high, followed with another higher high. Along with that, we have a higher low, another higher low, and it's followed by its final higher low. So far, this trade is in an uptrend, and that makes complete sense. However, what happens when we create a lower high? Does this mean we should go short because we did not break this previous high? No. However, what about when we break this previous higher low? Does this mean we should go short? And the answer is once again, no. Why is that? In this example, we can see that the trade actually ended up making a new low. However, if you entered into a short position, this still moved to high of day. Based off of my previous example that I just talked about, I said with an uptrend, you need higher highs and higher lows. When we created a lower low, shouldn't that be an indication of going short? And if so, why did we actually move back up to high of day? Well, to understand what happened, we need to be able to analyze market structure like a professional trader. So in this video, I'm going to give you the 3 simple steps to analyze the market every single day. And then I'll show you some real examples with this exact 3-step market structure strategy. And that way, by the end of the video, you can actually implement this in your own trading to see more results. So when we're analyzing the market, step 1, we need to go on the higher time frame. This is so important, and a lot of traders miss this because they're so focused on the lower time frame or they're focused on scalping. But in reality, if you can combine the higher time frame with the lower time frame, this is going to give you the best entry possible. Now, how do we do this? For myself, the first thing I look at is the daily time frame. From the daily time frame, I'll go over to the 4-hour time frame, and finally from the 4-hour time frame, I'll head on over to the 1-hour time frame. So on the higher time frame, I only look at 3 higher time frames, and then from there, I'll actually look to enter on the lower time frame myself. However, it's very important to mention, you don't want to look at every single time frame because then it's just going to be too much noise. In my opinion, when you're looking at the daily time frame and you can create a thesis from the daily, the 4-hour, and the 1-hour, that's going to be the highest probability thesis rather than looking at every single time frame possible. So for myself, I only look at the daily, then I'll go to the 4-hour, and then finally I'll go to the 1-hour to really curate the thesis going into the day. Now, when I actually look at these higher time frames, what am I doing? Well, on the daily time frame here, we can see exactly what happened on that previous example I showed you. We have a low down here, we create a brand new high, we create a higher high. However, we come back down and we create this low, which is actually lower than this previous higher low. And where most new traders get confused and want to go short, the market actually starts moving to the upside from this level, and we're breaking highs for a brand new high. Therefore, for myself on the daily time frame, this is a clear sign of a bullish stock. From there, I'll zoom in on the 4-hour time frame to really see what type of price action we're getting. In this example, this is very clear. We had this consolidation. Once we broke out of this consolidation, we created a new high. And as you can see, every time we're creating these new highs, we're getting these retests as well, which shows me that this is strong price action. With this consolidation, we got a retest right here. With this consolidation, we got a retest right here. And finally, we're moving to the upside, and now we're getting another consolidation. So for me, it is very clear on the 4-hour time frame that we're in an uptrend. However, we are now consolidating. And finally, on the 1-hour time frame here, we really don't get too much more information than we would on the daily or 4-hour. So for this example, I will simply use the 1-hour to create more of a thesis than anything else. However, how are we actually supposed to create that thesis, and how are we supposed to understand where the market structure actually breaks? So to understand where the market structure actually breaks, you need to know the difference between BOS and CHOCH. This stands for break of structure and change of character. This is going to be the difference between a correction and a reversal. What is a break of structure? A break of structure is simply a continuation in the trend. When you get a break of structure, that simply means if you're in an uptrend, that will continue, or if you're in a downtrend, that will continue. In this example, we can see when we break those highs every single time, that is what is called a break of structure. This simply means that we should still look for continuation in the uptrend. However, when we get a change of character, that is what is indicating to us a potential trend reversal. It's very important that I said potential trend reversal. The reason it's potential is because this doesn't give me 100% certainty that the stock will 100% reverse. However, this shows me that the stock may be slowing down, and this is time that I could look for a potential reversal. However, I am not forcing or being aggressive with that, because for myself, I much rather enter on break of structure than a change of character. So when we see this example here, we can see we got a high, another high, and finally the last high. This is all break of structure. However, when we put in this last high and came back down to create a higher low, we actually ended up breaking below that level. This is the exact same thing that we did in our previous example. However, what is the difference between the example I showed you compared to the example here? The example here created a brand new high and then came down and created a lower low. In the example that I showed in the beginning of the video, the trade actually never created a new high before creating that brand new lower low. Therefore, you have to understand, to get a change of character or to look for these reversals, you need to first put in either a brand new high or a brand new low. And then if it breaks that previous higher low or that previous lower high, then you should be looking for a potential trend reversal. So for the example we're using, before I tell you if the green line is a break of structure or a change of character, or the red line is a break of structure or change of character, I want you to put your answer in the comments down below to see if you really understand how to analyze market structure. But in this example, if we break back above this green line or this high, this would be our break of structure. The reason this is because we have a high, we have another equal high, and therefore if we break this high, this shows, because we are already in an uptrend, that this uptrend will continue. However, if we break below this red line, this is the higher low that we put in, and if we break back below, this is now going to be the change of character. Once again, this is only the change of character because we have already identified and put in a brand new high before moving back down. Therefore, it needs to hold this previous higher low for that continuation move to the upside. So the red line is the change of character, where the green line is the break of structure. And finally, for step 3, we go to the lower time frame for our entry. This will help filter out noise. In this example, we can see we had the break of structure here, and we're actually getting the break of that break of structure. Therefore, this shows us that yes, this stock is strong, and yes, we are looking for a long position when we are looking to take a trade in the day. And finally, we move on over to the lower time frame. So we were on the daily time frame, we then went over to the 4-hour and 1-hour to create our thesis, and finally, here we are on the 1-minute time frame. On this 1-minute time frame, what were we looking for? Well, we were looking for first the break of structure, which we got right here, a candle close above this 244.54 level, and then we were simply looking for a retest. In this example, we got that retest. We also got strong price action near that retest, so we would enter into this area for at least a 2R multiple. Our stop loss would simply be a break of this previous pivot level on the 1-minute time frame, and our profit target would be all the way for at least a 2R multiple. In this example, this comes at 246.53. So now that I explained the 3 simple ways to analyze market structure like a professional trader, let me show you some real examples. So on this example, we're on the daily time frame, and what can we see? Well, the first thing we have to do is identify that basic market structure. As we can see, we created a low down here, and then we created our high up here. After this, we created another higher low, and from there, we are now creating a brand new high. So very clearly, we can see low, high, higher low, and then of course a higher high being put in here. On the higher time frame, our thesis is extremely bullish. Now, from the daily time frame, we're going to hop on over to the 4-hour time frame. And what do we see on the 4-hour time frame? Well, the 4-hour time frame will simply help us analyze market structure a little bit more clear. And when we actually zoom in on what's going on, we can see this low being created down here. And from this low, we then created another low right here. So on QQQ, on the 4-hour time frame, as long as we hold above this low right here, which is 524.65, this would be where we could get a potential change of character because we just put in a brand new high. However, as long as this low holds on the 4-hour time frame, we are still going to be looking for that bullish case scenario. Now, for the final time frame on step 1, we have to go to the 1-hour time frame, and on the 1-hour time frame, we can see that we have this high up here. This would be the break of structure. As you can see, it was very easy to create a clear thesis very quickly. We have our change of character down here on the 4-hour time frame. We have our break of structure on both the 4-hour and 1-hour time frame right here at this high. So what would we be looking at for our actual entry? Well, now that we have step 1 and step 2 down, let's go over to a lower time frame for the final step 3, and that is actually entering the trade. And once we come over to the lower time frame, as we can see here, what we want to see is simply a break above this previous high, a retest, and then a continuation move to the upside. Now, for us, we're simply going to be waiting for that low risk retest on this specific level. If we don't get it, then we can look for a potential retest of simply pre-market high up here as well. However, we need to see the break of structure to go long on this name. So let's play out this trade and see if we can get a potential entry. So right off the bat, we can see on the 3rd candle right here, we actually broke above. This is giving us a break of structure. And now we are retesting not only the pre-market high, but also the higher time frame level of resistance, which is the previous day high. I also have a full strategy video going over exactly how to use the previous day high and low. That's going to be in the link in the description. If you haven't watched that video, you can watch it after this video. However, we're going to go long on this position here. Our stop loss can simply be a break of this pivot structure on the lower time frame because we are momentum traders and we are trading on the lower time frames. Therefore, for us, precision is key, and we get precision by entering on the lower time frames but having the thesis on the higher time frame. And finally, we need at least a 2R multiple. A 2.37R multiple comes at 534, which is a whole psychological number. This means for every $100 of risk, we would make $237. So let's enter into a long position here and see what happens. And as we can see in this example, we didn't even have any drawdown. This trade worked very nicely to the upside and resulted in $1,760 by simply understanding how to analyze the market like a professional trader. Now, let's go look at one more example to really make sure you understand how to analyze the markets. So we just did a bullish example, but I want to make sure you understand exactly how to be bearish as well. In this example here, we're on AMD, and so far you can see that we had a really nice move to the upside on the daily time frame. However, as we can see, when we created this high, we had to hold this previous low. Unfortunately, when we came down, AMD was not able to hold that low, and we actually had a potential sign of a trend reversal or a change of character. After we had this on the daily time frame, this was simply a potential sign. However, we can see when we came back up to retest this level up here, which was the two equal highs that we put in, AMD came up, we rejected this level and then made a nice move to a brand new low. And therefore, for myself on the daily time frame, it is very clear that AMD is indeed in a downtrend. As we can see now, we have another lower low right here, and we have a lower high here as well. So on the daily time frame, our thesis is very simple, and that is bearish. Now let's go over to the 4-hour time frame. Now here we are on the 4-hour time frame, and what do we see? Well, once again, lower high, and the final lower high. Along with this, we see lower lows, lower low, and another lower low here as well. So we know that this stock is clearly in a downtrend on both the daily time frame and the 4-hour time frame. So let's confirm this on the 1-hour time frame and create a thesis to enter the day on. So on the 1-hour time frame, what are we looking at? Well, we can actually see on the 1-hour time frame that we had a really nice move to the downside the previous day. And on the previous day, we actually created the low of day right here. So for myself, what I would be looking at would be a break of this previous low, a breakdown, a retest of this previous day low, and then a move to the downside. This is because from the previous day low, this is where the break of structure would occur, and then the retest would be the lowest risk entry. And our targets in this example here could simply be this previous pivot low where we see we had the equal two body wicks. So let's go over to the lower time frame to actually execute this trade. So here we are on the lower time frame, and all we're looking to do is simply break this level to the downside and then look for a potential retest. So let's play out this trade and see exactly what happens. So right here, we can see we actually got the breakdown right here, and we're getting the retest. Now, there's not as much displacement as I would like on this retest. However, because we have that strong thesis on the higher time frame, we can still look to enter into this trade based off of our higher time frame thesis. And on the lower time frame, this is going to be the lowest risk entry. We would enter into a short position here. Our stop loss can simply be a break above this previous candlestick, because if we actually end up getting a candle close above this level again, this would show us that buyers are stepping into the stock, and our profit target, like I said, will be all the way back down at this previous pivot low structure on the higher time frame. So as you can see, if you trade my 5-minute retest, or if you trade the previous day high or pre-market high and low retest, all of those setups will still work. And even though you don't need a bias for them to go into the day and actually trade, if you do have a higher time frame thesis, you can capture those moves with the entry and precision of the lower time frame, but the volatility of the higher time frame. So with that being said, let's go into a short position and let's see exactly what happens. And just like that, as we can see, in about 5 candles, we made $840 by simply understanding the bearish sentiment on the day by analyzing the markets using our 3 simple steps. Now, really quickly, before we continue to the next lesson, if you'd like my 7 years of trading experience, all the lessons that I've went through, the mistakes I've made, the setups I've tried, the setups that work, and what it truly takes to become a day trader, I have an absolutely free ebook with so much value over the last 7 years of my trading journey. So if you'd like to get the free ebook and learn more about my trading system and truly see what it takes to be a real trader, that link is going to be in the description. Now, this is going to be the most important part of the video, and this is my exact scalping strategy. I'm going to explain exactly how I trade, when I trade, and the exact setups that I use to trade with and have been using for the last 7 years. Let's get into it. Now, there's a couple basic things we need to understand about scalp trading before we get into the strategy strategies. Number one, we are trying to catch the quick movements in price. Therefore, we are not trying to stay in the stock too long. The purpose of scalp trading is, let's say we have a stock and it comes back into our key level. Well, based on where we bought it, we want the stock to work in our favor right away. If the stock starts consolidating or moving down, then we simply exit the stock and look for the next opportunity that may present itself. However, the benefit of scalp trading is because we're looking for these quick movements in price, we do not have to sit in front of the screen for hours. Number two, we want to catch the big move, not the full move. The problem with a lot of traders is when they see a stock coming back into a key area of support, they will try to capture the absolute bottom and then they will try to time the absolute top to sell. And because of this, they are trying to capture this full move that happened. When in reality, the most profitable traders understand we're not going to be able to capture the absolute bottom on this stock or the absolute top. However, our goal is to capture the majority of the move, meaning that as long as we can capture the big piece of the pie, even if the stock continues to the upside, it doesn't matter because we got our scalp trade in for the day and we made our profit. And finally, number three, we want to be done the day early. This is one of the biggest benefits in scalp trading because we are scalp trading and we want to trade when there's the most volatility in the market. We are most likely going to be done our day early and we don't have to sit in front of the screen for hours trying to actually trade. Because at the end of the day, you guys know the reason we want to trade is for freedom. And you don't get freedom by sitting at the charts all day long because we want to be done the day early so we can enjoy the things we actually want to do with friends and family, or even if you work full time, you can still do this right in the morning. Now, with this being said, a couple more important concepts for scalping. Like I said, we want to capture the quick movements in price, and to do this, we need trending markets. This is extremely important. Now, for trending markets, this simply means when we are looking at an uptrend, all we want is a stock to make a high, and as we move to the upside, the stock creates a new high, meaning that this low right here is higher than this previous low and the stock continues in trend. This way, even if we mess up our entry a little bit on the stock, because we are still trending to the upside and we are buying this position for that move to the upside, we still have a higher probability chance of this trade working in our favor. Now, the other way you want to look at the stock is a downtrend. Now, for the downtrend, all we want is lower lows, meaning right here, and we want lower highs. So as a stock continues to move to the downside, we simply want these lower lows and lower highs to be put in. Once again, the same formula as an uptrend. Even if we mess up the entry, for example, we end up buying right here, which is already past low of day, because this stock is trending to the downside, we have a higher probability chance of this trade working in our favor, even with a scalp, rather than it just consolidating. The one thing you do not want to trade when you're scalp trading is range action, and that is simply when the stock is in fair price and moving up and down like this. This is where most scalp traders end up blowing their accounts, and this is most likely the price action that you've personally experienced before and you have not seen good results. Therefore, for me, I only trade an uptrend and downtrend. When we actually get to the examples in this video, we'll demonstrate this much more clearly. Now, number two, like I said, we want to capture big moves, not necessarily the full moves. And to do this, we need stocks that are liquid and have volatility. You have to understand, not all stocks are liquid, meaning you can get in and out of the stock quick. And along with this, some stocks are simply not volatile. Therefore, for me, if you've been watching this channel for a little while, you understand I trade the same stocks every day. This consists of SPY, QQQ, Tesla, Apple, Nvidia, a lot of the big tech names that you guys may know of. And also I trade futures as well sometimes. So I'll trade ES or NQ futures. If you trade mini contracts, you can also trade MNQ and MES as well. However, these are stocks that actually do have volatility and liquidity. Therefore, it is very easy to get in and out to actually make profit. And therefore, for myself, I like to stick to the same basket of stocks. Now, with this being said, the scalping strategies that I will explain in this video do work for any instrument type, may that be options, shares, forex, crypto, whatever you really trade. However, for myself, I specifically trade options and futures. And finally, we want to be done the day early. This is key. Now, the reason this is because the highest probability chance of the trade working out usually occurs from 9:30 a.m. Eastern to 11 a.m. Eastern, and that's because the New York Stock Exchange opens at 9:30 a.m. Eastern. Therefore, this is when the most volume comes, and this is when we can capture the big moves early and just be done the day rather than sitting in front of the screen for hours. So for myself, I only trade from 9:30 a.m. to 11 a.m. Eastern. Now, let's talk about about systems and strategies. For me, every single strategy that I'm going to talk about in this video with the examples as well that you guys will see, and by the end of the video, you'll actually have the actionable steps to actually trade this system. It all revolves around the break and retest. What does this mean? Well, we can see that there is a clear trend here. We had this high up here, which was a key level. We can see this high kept getting rejected, but as we had this high, we were creating this low, and then we created a higher low, and now we can see we got the breakout. This breakout gives us a brand new high, showing what? An uptrend, right? So higher highs, higher lows. And what do we want now? Well, after a breakout, the healthiest thing for a stock to do is pull back, but pull back into a key level. Now, where is that? We get the exhaustion or the retest, and we retest what? This previous key level. When we come back for this retest, we can see that there are some sellers sitting here. However, when the buyers step up, as we can see here on this candle, buyers are stepping up, then we see a nice move to the upside. So in the most simple terms, all I'm looking for is simply going to be a break above a key level, the retest of that key level, because this is going to be where buyers need to hold the stock up. This is now resistance turn support. And then I want continuation in the trend to the upside. Now, if you don't understand price action and exactly how candlesticks form, I have a full in-depth video on that, along with the full playlist on exactly how you can start trading from scratch. So if you do want that full playlist and course, that's going to be in the link in the description. But with that being said, the three most profitable scalping setups that we'll talk about in today's video is going to be the 5-minute opening range, the previous day high and low, and the pre-market high and low strategy. Now, for all of these, I'm going to give a quick summary on exactly how they work, and then we'll hop onto the charts and look at real examples of every single one of these setups. So by the end of the video, you'll actually have setups that you can trade today to see consistency. Now, the first thing we have here is a 5-minute opening range. What does this mean? Well, here we are on the 1-minute time frame. And on the 1-minute time frame, all we're going to do is we're going to mark out the first 5 candles that form. So 1, 2, 3, 4, 5. As we can see, here is the 5-minute high. This is the candle's high. And the first candle was the 5-minute low. So we mark out with the green line, the 5-minute high, and with the red line, we mark out the 5-minute low. And all we're waiting for the stock to break out of this key level, come back, retest for the entry. As we can see here, we got strong price action. This is very key to understand strong price action, but as we can see, very simple entry. And if we entered in here with our stop loss simply at a break below this candle right here, and our profit target at least a 2R multiple, in this example, it was actually a 3R multiple, we can see this trade worked out extremely nicely. And this was a 3R trade, meaning for every $100 of risk, we made $300 of profit. Now, this is very key because as a scalp trader, you don't need the highest win rate as long as your risk to reward is at least a 2R multiple. So one of the main things that I look for is every single trade I take, if I'm risking $100, that means I have to make at least $200. If I'm risking $1,000, that means I have to make at least $2,000. So every trade that I take, my investment essentially has to 2x on that trade. With that being said, let's go over to the next setup. Here we are on the previous day high and the previous day low. All we do for this strategy is mark out the previous day high. Now, the previous day high occurs from 9:30 a.m. Eastern to 4 p.m. Eastern. So from 9:30 a.m. Eastern to 4 p.m. Eastern, you mark out the high and low of the day. And once again, all we're waiting for is a breakout of that key level, the retest with strong price action. Once we get strong price action, we can target high of day or at least a 2R multiple. In this example, the 2R multiple was at high of day, meaning for $100 of risk on this trade that we put on, we would have made $200 in profit. Now, if any of these strategies or setups you don't understand, don't worry, when we do get to the examples in this video, you'll be able to see this much more clearly. And finally, here we have the pre-market high and the pre-market low. For pre-market here, all we do is we mark out the high and low of the pre-market session. Pre-market session is from 4 a.m. Eastern time to 9:30 a.m. Eastern. And as we can see, this is just the gray shaded area right here. We're going to mark out the high and low of the pre-market session. Once we actually enter in on the day, all we're waiting for is the breakout. As we can see, the key level, we have a clear uptrend. We're making higher highs and higher lows. We come back for the retest. We get very strong price action here. Once we see that strong price action, we enter in with our stop loss simply at a break of this key level and our profit target at least at high of day. At this high of day level, we get the 3% 3.28R multiple, meaning for every $100 of risk, we would make $328 of profit. This also means if you were to risk $500 on this trade, you would make $1,640, or if you were to risk $1,000 on this trade, you would make $3,280. So because of this, technically, if you lose 3 trades in a row and win the last trade, you would still be break even or even profitable on the day. And that's why with these scalping strategies, it's not really about the high win rate, but rather managing your risk to reward and understanding the good setups. Now, with this being said, I explained exactly how scalping works, the key things you should be looking out for. But now with all 3 of those setups that I just explained, let's go look at real examples on the chart while they were happening so you can actually see how you can execute these trades on the real chart. And by the end of the examples, you'll have enough information to actually implement these strategies in real time. All right, so here we are on our first example. In this example, I'm going to show the 5-minute opening range retest. So all we have to do for this example, as we can see, we have pre-markets here. We do not have to mark out anything until the first 5-minute candles form. So 1, 2, 3, 4, 5. Now that the first 5-minute candles have formed, all I'm going to do is mark out the high of the first 5-minute range, and I'm going to mark out the low of the first 5-minute range. Now, with this scalping setup, what we're looking for is at least a 2R multiple, meaning for every $100 of risk, we need to make at least $200. And to actually form this setup, all we're looking for is a break above this key level, a retest, and a move to the upside. Or we can even look for a break below, a retest, and a move to the downside. If you don't understand by now, with this setup, you don't need a daily bias. You don't need to come into the day with a very strong bias on which way the stock will move. For myself personally, I can come into the day with a thesis of what I think should happen, but it's very important that you remember when you come into the day, what you want to do is react to price action. We never want to predict, but rather react to the same patterns that we see on a daily basis. Now, with this being said, let's play this chart out and see exactly what happens and if we do get that 5-minute retest. So far, we can see we actually moved down into the 5-minute low, but we did not break that level. And one of the great things about the 5-minute range retest is that it actually allows you to not be stuck in this consolidation or chop. As you can see, we had some consolidation here, but we were not stuck in it. We did not have any entry. But now when we're actually coming back into this area, what is happening? What we can see here, we have the 5-minute range, we broke above, and now we are retesting. What does this mean? This was first resistance. It is now turned into support. We see buyers stepping up, showing that buyers understand that we need to hold this level for a continuation move to the upside. And therefore, I would be interested in a long position here. For my stop loss would simply be a candle closure below the candle that I entered in on. This also aligns with this pivot high right here. And for my profit target, I need at least a 2R multiple. At high of day, we get only a 1.39. So in this example here, we can use the 529.50 level. This is a previous day pivot level from the day before. And now all we're going to do is enter into this position and see exactly what happens. Like I said, this is a 2.29 risk to reward trade, meaning for every $100 of risk, we should make $229. So let's see what happens. And as we can see in 1, 2, 3 candles, or essentially 3 minutes into the trade, we made $1,150. Now, the market opened at 9:30 and we are done our day at 10:01. We only traded for 30 minutes on this specific day and we made $1,150 by understanding this simple scalping setup. This is the 5-minute opening range. You can use this either to the bullish side or the bearish side, but now let's go over to the previous day high and low strategy. All right, so here we are on the previous day high and the previous day low example. All we did was mark out the previous day high. As you can see, the previous day high starts from 9:30 a.m. to 4 p.m. Eastern, and we marked out the previous day high and the previous day low. Pre-market, we are actually breaking above the previous day high, so what do we want? We simply just want the stock to break above this previous day high, come back and retest this previous day high for the continuation move to the upside. So let's play out this trade and see exactly what happens intraday. So far, we can see we are getting that break to the upside. And really what we want to see is the retest into this key level. So that's what we're going to be waiting for. And so far, we're just really seeing consolidation near this previous day high level. And here we can see we came into that previous day high level and what happened. This is where it's important to understand price action when you're scalping. Now, like I said, I have a full in-depth price action course for free on my channel. The link to that is going to be in the description for that playlist. But as we can see, so far, we moved to the upside, we came back for the retest, we already broke out, and now we're simply just waiting for this retest to happen. Now we can see the retest already happened at this previous day high, and we had to wait for a little bit of price action to confirm that buyers are stepping in near this previous day high area. A lot of traders simply don't wait for that confirmation of buyers stepping in, but as we can see, we created this lower wick, and on top of that, we are seeing that extremely bullish price action. So how would I enter into this trade? Well, I would enter into a long position here. My stop loss will have to be a break below this key level or this candle that was the low of day candle or the retest candle, and I need at least a 2R multiple. In this example, the 2R multiple comes at the 678 whole psychological number. If you don't understand where I'm getting these psychological numbers from, these are simply whole numbers. So in this example, it would be 678. That's a whole number. That's where most institutions are going to be buying and selling, because we know institutions and hedge funds buy at psychological numbers rather than numbers like 678.54s or 678.66. Those are random levels where big institution orders are usually placed at whole numbers. So with this being said, we can enter into a long position here, and let's see exactly what happens for this trade. And just like that, we were able to capture this entire move back to high of day, and we even got continuation into our 678 key level. Like I said, this was a 2R trade, and it was a very simple way to capture this movement on Meta. Now, this was the previous day high and low retest. Let's go over to the final example, which is the pre-market high and pre-market low. So here we are on our final example. This is going to be the pre-market high and pre-market low setup. Now, for this setup, all we're going to do is, like I said, from 4 a.m. to 9:30 a.m. Eastern, this is going to be the pre-market low, and we're going to mark out the pre-market high. Now, once we have these levels marked out, all we're looking for is a break above, a retest, and continuation to either side. This could either be to the upside or to the downside. All we're looking for, like I said, is the break first and then the retest. The beauty of the setups that I'm teaching you in this video is that you don't have to put too much mental focus. You simply wait for the key level to break. Once it breaks, then you wait for the retest. If you get strong price action on the retest, you enter in and you look for continuation. It is really that simple. You do not want to overcomplicate your trading with a bunch of different indicators and a bunch of different confirmations. You want to keep it simple and repeatable every single time. So with this being said, let's play out this trade and see exactly what happens. Here we can see we got the breakout right away, and we are also getting the retest right into where this pre-market high area. So we would simply enter into this trade here. Where would our stop loss be? Our stop loss can simply be a little bit below this candle right here that actually had that impulsive move to the upside, and our profit target needs to be at least a 2R multiple. In this example here, we can simply just aim for that 204 psychological number. Like I explained in the last example, we use this because this is where institutions are placing their orders as well. And this would be a 2.88 risk to reward trade, meaning for every $100 of risk, we would be making $288. So let's enter into this trade here and see exactly what happens. As we can see, this was a simple $500 trade in 1, 2, 3, 4 minutes by simply understanding how the pre-market high and low setup works. Now, though I am showing you the example of this trade, this actual trade was taken live in real time with my executions in front of hundreds of traders, and they were able to capture this trade with me in the accelerator, not only because I was explaining it in real time, but because they understand this simple setup that they can trade. Now that we understand the setups, how can we avoid some of the bad trades that we take, and how can we confirm even more high probability trades? Well, I use 3 simple steps that help me confirm my high probability trades, and this way I always enter the right way on trades. First, I will simplify the summary of all 3 steps that I use to enter high probability trades, and then we'll look at real examples. The 3 steps we'll talk about in today's video is identifying key levels, observing price action, and finally how to wait for confirmation for the highest probability entry model. Now, for step 1, we need to identify key levels. Personally, for me, I use the same levels every single day, and this way, this system is very repeatable, it's consistent, and I don't have to change it by looking for different key levels every single time. I use the exact same key levels, and these consist of the previous day high, which is this green line, the previous day low, which is this red line right here. Now, these previous day high levels come from 9:30 a.m. to 4 p.m. Eastern. I mark out the high and the low of the 9:30 a.m. to 4 p.m. session, and then I will mark out the pre-market high and pre-market low for the day that we are actually trading. In this example, this starts from 4 a.m. Eastern to 9:29 a.m. Eastern. I will mark out the high and low of that session, and finally, I will mark out the 5-minute opening range high and low. So those are the only key levels that I'm marking out on a consistent basis every single day, and from these levels is how I'm actually going to enter the trade. You can see already that I try to keep my system as simple as possible because, like I always say, simplicity equals profitability. And in this video, you will learn exactly how simple the system is to actually make consistent profits. So once I have these levels marked out, we can see, what did the stock do? It came up to the pre-market high level, which is this white line from the previous example that we just saw, and it was rejecting this level. So you can see that sellers were coming in and they were very strong near that level. We had a very nice move to the downside with impulsive candles showing that sellers were stronger. Low of day was right here, and we can see that we broke below low of day and we hit the pre-market low. We bounced from the pre-market low because that's where buyers stepped in. And now what are we doing? We are retesting the previous day high. Now, if you've been watching my channel for a little while, you know the way I trade is extremely simple. I look for the breakout of a stock and then I will enter in on the retest. Every single time I need to see the break and retest of a specific key level happening for me to enter the trade. In this example, we can see on the short side, we came down. We're retesting the key level for a continuation move to the downside. Based off of the key levels, I would enter into the trade here, looking for low of day or this pre-market low level, which we know the stock has to gravitate towards, because the only reason I mark out these key levels is because this is where the most liquidity is. The pre-market high levels, the pre-market levels, the previous day levels, and the first 5-minute opening range levels. If we enter into this trade here, what happens? Well, as we can see, if we went short on this trade right off the previous day low level and we targeted out this pre-market low level, we would have made $5,240 by simply just marking out these 3 key levels. You can see we waited for the break, we got the retest, which is our setup, and then we got continuation to the downside of the pre-market low. And this was a $5,000 trade, yet it was simple for anyone to understand and actually execute in real time. However, I want to be as transparent and real as possible, and this is why just key levels is not enough. If it was just key levels, a lot more traders would be profitable. We need to add 2 additional steps to see more profitability in the markets, and the beauty of these steps are they're simple, yet if you implement them the right way, you will see your win rate increase and you will see more profitability. So step number 2, we have to observe price action. This is very key. I want to ask you a very simple question. In this example, we can see that the stock broke below the pre-market low level and now it's coming back up for the retest. Would you enter into this retest? Because just like I said in the previous example, we have the pre-market low, and if this is a key level and we're coming up for the retest, just like how I explained to you, you technically should take this for a short position back to the downside, correct? However, if you took this trade to the downside, you can see we never actually hit low of day, so you never got your profit target, and this trade came all the way back up, which means you would have lost this trade and you would have lost $1,000 because you did not observe price action the right way. Now, what does it mean to actually observe price action the correct way? As we can see in this example, most of these key levels are not as important. The key levels that are the most important are the ones that come near the pre-market low. A lot of new traders will be looking at every single candle move on the 1-minute time frame, and that's exactly how they get chopped out. For me, I only pay attention to the price action near the specific key level. And in this example here, you can see the candle that we actually ended up going short on. What does it show us? Well, it shows us that we opened up down here on this candle. Sellers tried to bring it down. However, buyers had an impulsive move back to the upside near the highs of this red arrow, and we closed close the candlestick, right? Because this is where the body candle closes above the pre-market low level. So us going short on this position doesn't make sense because it was showing so much strength. What we should have done is waited or not entered this trade at all. And by simply waiting, we would have avoided this $1,000 loss by understanding price action and observing it near those specific key levels. Now, those two steps are very important, but this last step is a simple trick. It will increase your win rate because I've personally taught many traders to implement this in their trading and they've seen their win rate increase tremendously, and that is waiting for price confirmation. So right now, I want you to pause this video and tell me which entry is better for a short position. Is it option A or is it option B? In the comments down below, let me know. Is option A a better short entry or is it option B? If you picked option A, you can see this one clearly had a very nice move to low of day and even continuation. However, if you picked option B, you can see this one unfortunately failed. And though it was a break and retest and both of the setups look very similar, this one had a reversal back up to high of day with an impulsive move to high of day, whereas this one had a really nice continuation to low of day. So what was the difference and how can we use step 3 to really confirm the best entry on the chart? The reason option A won was because we waited for stronger price action. Now, what does stronger price action confirmation actually look like? Well, we had a clear trend with a flat bottom. We had a retest of the flat bottom. And most importantly, candles showed sellers were holding the stock below our key level. And finally, we entered in on confirmation. So if we look at this trade, what is the number one thing you can see? Well, you can see that there is a clear line of support right here. Once we broke below, you know that is the breakout. So what we're waiting for is the retest. Now you could have entered in on this first retest here. However, you can see on either retest that you entered on, you would have gotten weak price action. Why? Because you can see the upper wick here and we can see the upper wick here 2 times as well. And what this indicates to us is near this key level that we have, this is going to be a very low risk entry, but also high probability. Why? Because we waited for the candle to close. Now, let's say when we came back into this level, we just entered in on an immediate retest. Well, what if the candle actually came back and closed above the key level? Now, all of a sudden, where you thought this was going to be a bearish trade, it actually turned out to be bullish and you ended up losing that specific trade. So for step 3, it is very important every single time we come into our retest level or any trade we take, when it comes into a level, we need to wait for the candlestick to close before we enter the trade, because then that allows us to A, gauge price action better, and B, have a much more clear defined risk level. And because of this, this will help us not only increase our risk to reward, but also our win rate, because it will completely block out trades that we may potentially enter that end up closing strong above a key level or weak below a key level. So far in this video, we just talked about identifying key levels, observing price action, and waiting for confirmation. However, just looking at the summary helps you understand the concept, but you still don't know how to execute these steps in real time. So now let's go look at some real trading examples so you can see exactly how I use these 3 steps in real time. All right, before I show you a live example of how to enter high probability trades using the 3 simple steps we talked about in this video, first, to make sure you understand, I want to show you a quick example. So the first step we have to do is always mark out our key levels. Like I said, our key levels are going to be the previous day high and the previous day low. This once again is 9:30 a.m. to 4 p.m. Eastern on the previous day. Then we want to mark out our pre-market high and pre-market low. In this example here, you can see my pre-market high and pre-market low. This is from 4 a.m. to 9:29 a.m. Eastern. And now all we have to do is mark out the first 5-minute opening range. This we will do when the market actually opens, but before the market opens, these are the only 4 levels that you need to have on your chart. So let's play out the day and see how the first 5-minute opens. So the first 5-minute range has now been developed on the chart. We can see the 5-minute high and the 5-minute low. So we're going to mark out once again the resistance or highs with the green line, or the support or lows with the red lines down here. And now all we're simply waiting for is a break below these levels, a retest, and then we will look for continuation on a downside move, or we're simply waiting for the break above this key level, the retest, and then continuation to our next key targets. Now let's play out this trade and see exactly what happens. So far, we can see we came up to pre-market high, we rejected that level for a move back down, and now some people may be thinking this is the 5-minute high retest, which it is. However, why were we able to avoid this setup? The reason we were able to avoid this setup is very simple. We can see that this candle actually closed below the key level. So the first retest candle that came down is closing below the 5-minute high. Because of this, this shows me that buyers were not aggressively buying this stock when we did come to that 5-minute high, and therefore this was a loss that was easily avoided by simply understanding that we had a candle closure below, and this is exactly why we wait for all 3 steps. If we didn't wait for this candle closure and entered in just on the immediate retest, we would have been caught in this trade. However, because we were able to understand that the candle closed below the level, that means sellers are a little bit stronger than buyers, we were able to avoid this trade, and we are still looking for a potential entry. Here is where I see a potential entry. Now, what do we see? We see that buyers were not able to bring the stock above the pre-market high level, therefore there was no entry there. We see on the 5-minute retest, they were not able to hold the stock above the 5-minute high on the first candle, therefore there was no entry there as well. And then we got an impulsive push down. We retested where? We retested the 5-minute range high for a move all the way down below low of day. So now we are below the low of day, plus we are below the pre-market low and the 5-minute range low. On top of this, because we are below this, we are also retesting not only the 5-minute range low, but also the pre-market low after a really nice trend continuation to the downside with weak price action and candle closures below both of these levels. So for me, this is a high probability trade setup. What I would be doing is looking to go short on this name. My stop loss would be a candlestick closure above this up close candle wick. If you don't know how to read market structure, I have a full playlist in the link in the description, which will explain exactly how to start trading as an absolute beginner. It will go over every single concept in detail that you can watch after this video. However, my stop loss is simply going to be the body open of this up close candle, and my profit target needs to be at least a 2R. In this example here, we can simply target out the previous day low because we know that's where the liquidity levels are that this trade will most likely target. Now, this is a 3.42 risk to reward trade. Let's enter into a short position and let's see exactly what happens. And we can see just like that, very simple, we entered in on the short retest of the pre-market low plus the 5-minute range low. You can see it came up a little bit back into that 5-minute low, but never really gave us that candle closure above that key level. And then we had a really nice push to the downside, which is the previous day low, which is the next liquidity level that the stock should gravitate towards. And this was a $1,740 trade by simply using the 3 steps that I explained in this video. Now, let's go over to a live trading example where there was real money on the line, and I was doing this in front of hundreds of traders, so you can see the exact thought process on how to use these 3 simple steps every single time. And by the time you're done watching that example, you will have enough information to implement this by yourself in your own trading. All right, so in this example on NVIDIA, this 118.19 level that I have is the previous day high. But on top of that, if you notice, the 5-minute range high is also right below, which is right here. So we have not only the 5-minute range high at this level, but we also have the previous day high at the exact same level. What I was looking for on this specific day was simply the retest back into this level and then continuation back to the upside. However, like I talked about in the previous example, now you will see in real time when I was live trading exactly what my thought process was and how I used all 3 steps that we talked about in this video to actually enter this trade. So let's play out this trade and see exactly how I entered.
NVIDIA above previous day high. So main watch really would be NVIDIA above previous day high, potentially for this retest of this 5-minute range.
So you can hear me say here, NVIDIA is above the previous day high, and the main watch is the 5-minute retest looking to go back long on NVIDIA. Now, let's see how the 5-minute retest actually presents itself.
Yeah, if NVIDIA can show strong price action, NVIDIA looks good here as well. 5-minute opening range retest.
So here you can hear me talking about the NVIDIA 5-minute opening range retest, but you can see we have 25 seconds until this candle close, and I didn't just enter because it touched touch the key level. Like I explained in this video, you have to use all 3 steps to actually enter profitably. So in this example here, we're already using the first step, which is the key levels. We have the 5-minute range and the previous day high level already marked out, and now we're waiting for 2 things. One is a strong price action candle to actually confirm that buyers are stepping in, and number 2 is for the exact same price action candle to close so we can actually enter in with a clear risk and clear reward back to the upside. So let's see and hear exactly what I did in real time to make these profits.
You want to see buyers stepping in on NVIDIA here off this 5-minute opening range. Yeah, I was just going to say NVIDIA looks really good here for a push to the upside. You can take the 120 or 119s. I ended up taking the 119 calls.
So here you can hear me say I entered into NVIDIA, and the reason I entered into NVIDIA here is very simple. First thing is the key level. We got that. Check. Second thing is strong price action. You can see on this 5-minute range, this first candle didn't give us the strongest price action, and therefore I waited until the second candle came in, and this indicated to me that buyers are stepping in aggressively. Why? Because we have a big lower wick, but on top of that, we can see the body candle closed at highs. This shows because the candle closed at highs, buyers are extremely aggressive near this buy area. So once that candle closed and I got the confirmation of the candle closing, you can see my stop loss is simply a candlestick closure below this key level, and I am targeting out high of day and continuation into 120s. Now let's see how this trade actually played out once I entered.
What we want to see is really high of day, and then that pushed into 119.25s with Qs kind of pushing up here. We need to see NVIDIA break back above 118.61s. Like I said, on NVIDIA, really what we need is that 118.61 candle closure above that level. If we can get that candle closure above 118.61, this has clear room up to high of day and even 119.25s on NVIDIA. We need that 118.61 candle closure above.
So as we can see, NVIDIA came back into our entry level, which is extremely fine. It is simply just consolidating a little bit before this next push up. And that's exactly what I'm explaining to everyone in Traders Lab and the Accelerator. Of course, I trade live every single day within Traders Lab and the Accelerator. And here, all I'm letting the traders know is we want to wait for NVIDIA to show strong price action above this key level, because once we get above that 118.60s, we have a clear shot into that 119.20 level. And then of course, 120s and above. So let's see exactly what happened on NVIDIA.
We just need a candle closure above 118.61s. Let's see if Qs can push back into 521.20s here. NVIDIA right back into that 118.61 level. Let's see if we can get a candle closure above. If we can move this thing back up to high of day, which is 118.96. There's high of day on NVIDIA here, still near this 119 area, 119/119.25. This is a key area on NVIDIA. Gonna take some off here.
Here we can see NVIDIA just got into our 119.20 area. This was the key level that I was talking about earlier. This is where I took a little bit of my first partials off. Like I said, every day I explain exactly where I enter and even where I take my potential partials. This is the first level. The next level is going to be that 120 level, and then potentially even 121s if we can get back up there. So let's keep playing out this trade and see what happens. And here, if we play out this full trade, we can see we entered in on this candle right here. We took our first partials at high of day right here, then 120s up here, and finally NVIDIA just hit that 121 area. So we were able to ride NVIDIA all the way up with, you can see, a very tight stop loss because we enter in very precisely on these trades using the 3 steps that we talked about in this video. This trade was taken live in real time in the Accelerator and Traders Lab, and many traders were able to take this with us live, not because of the signal, but rather because they understand the 3-step simple process that we use to execute our trades on a daily basis. So far in this video, we've covered technical analysis, we've covered strategy, we've covered exactly how to enter trades the right way, but now this is going to be extremely important, and this is risk management. This differentiates unprofitable traders and profitable traders. You need to learn risk management to see long-term consistency as a trader. This is what will keep you a trader and from not blowing your account. So let's get into my exact risk management guide. The market does not care about you. The main objective of the market is to keep the assets liquid. Most people, when they enter a trade, they think the market is against them. They think that the market makers are rigging the trade. But in reality, the market does not care about you. It doesn't know you exist. And that is just the harsh truth. So when you understand that, you start to realize the more risk or the more money you put into your trades when you're starting to learn how to trade, the lower your chance of survival or profitability in this market. Why? Because the more risk you put on, the more money you lose faster, the less chance you have of survival over a long period of time. Now, this is further illustrated in this graph. So here we can see the account risk per each trade and the amount of trades you can be wrong in a row. So if we risk 1%, then we can be wrong 100 trades in a row. But if we risk, let's say, even 10% per trade, well, if we're wrong 10 trades in a row, we will blow up our account. And this is important to know when we're first starting, because 1% account risk means we can be wrong 100 trades, right? As a new trader, you want to make sure that you give yourself the most runway in order to become profitable, right? The most time and the most capital preservation. If we take that same example with 50% per trade, this means if you have a $1,000 account, you risk $500 per trade. Well, you can only be wrong 2 trades in a row, and then you would blow up your whole account. So when you understand this, you need to make sure that you are not a trader that's risking 50%, because you're not going to stay in the game long term, right? You want to risk as little as possible in the beginning when you're learning to stay in the game as long as possible. Now, when we talk about risk, there's a lot of different risk metrics for a lot of different trading systems. So we have a scalper, a day trader, and a swing trader. A scalper most likely has a 1 risk multiple, a day trader has a 2 risk multiple, and a swing trader has a 4 risk multiple. What does this mean? This means that the scalper is looking for $1,000 of profit for every $1,000 of risk, whereas the day trader, for every $1,000 of risk, they want to make $2,000. And finally, the swing trader, for every $1,000 of risk, they want to make $4,000 in profit. Now, based off of this graph right here, wouldn't everyone want to be a swing trader? Because swing traders make $4,000 of profit for every $1,000 of risk. Well, the answer lays in the relationship between risk to reward and win rate. You need to understand, though a swing trader may have a 4 risk multiple, the average win rate of a swing trader may be decreased from a day trader because they have such a high risk to reward. So as your risk to reward increases, your win rate decreases, right? So this is your required win rate to be a profitable trader on the left side here, and then this is your risk to reward. So as we can see, this red line represents where you would become a profitable trader. And you can see here with the 2.5 risk to reward, you only need a 30% win rate to be a profitable trader, right? So you don't need a high win rate, but at the same time, you don't really need a high risk to reward either. As long as you have them both balanced, you can still be a profitable trader. Now, there's some traders that are going to be sitting at a 9.5 risk to reward, but they don't win trades often. And then there's going to be some traders that sit at a negative risk to reward, or a 0.5, meaning for every $100 of risk, they're only going to make $50, but they're winning the majority of their trades. For myself personally, the system that I explained throughout this video, it sits around this 50% mark with a 1 to 2R multiple. This is where I usually sit, and you can see in this table that this is a profitable setup. Now, here you can see a 1-year result of the 5-minute opening range break and retest setup. Now, this was a 2.53 risk multiple. This means for every $100 of risk, I was making $253. And at the same time, you can see the total number of trades was 185, and I won 106 trades. This means with a 2.53R multiple, I had a 57.2% win rate. And if we go back to the chart here, you can see that this is a very profitable system to actually trade, because both the win rate and the risk multiple are balanced. So contrary to popular belief, a high win rate does not equal trading success. Rather, you need the balance of risk management and your win rate. Now, if you've made it to this point of the video, that means you truly want to see trading success. And to master trading success, well, first you have to master your mind. Now, I'm going to lay out the most important lessons that I've learned in the last 7 years of trading, and I've made so many mistakes over the years, but if you truly listen to the next 14 minutes, this will help increase your trading psychology and look at the markets like a professional trader. Lesson 1. Focus on 2 to 3 setups. So many traders come into trading and the first thing they do is try to find the best setup possible. They will endlessly look for indicators, signal services, or strategies that they think will give them a 90% plus win rate. In reality, all this will do is slow you down in the beginning. This is because now, after 7 years of trading, I can tell you from first-hand experience, when I was first starting, I was trying to find the best setup possible. I was always looking for different strategies, different indicators, and I was really looking for the holy grail of trading, but it took me a couple years to realize it's not about finding the best setup or the best strategy with the highest win rate, because at the end of the day, you will never find something like that. Instead, what you want to focus on is keeping everything simple. In the beginning, my recommendation for all new traders is focus on one strategy, one mentor, and one financial instrument. This will save 90% of your time in the beginning. Now, what does this mean? When you're looking at a strategy, only focus on one strategy that you think aligns with your personality. In the absolute beginning, it's okay if you're looking for different strategies just because you want to find one that works for you. But when you finally get one that works for you and your personality, make sure to stick to that one strategy. Number two, you're watching this video on YouTube because you want to learn how to trade. There's thousands of videos on YouTube and there's so much information. In the beginning, you may get lost looking at all that information. So find one person that you think aligns with your trading perspectives and also has shown verifiable proof, and follow them because they've already made the mistakes that you're about to make and they can help you avoid them and also save money in the process. Now, in full transparency, this doesn't even have to be me. I want to make sure that I'm providing the best value to you as possible. But if you don't align with the way I trade, then you can find someone else. But when you do find someone, make sure to follow them and listen to what they say because they can save you years in your trading journey. And finally, focus on one instrument. You don't want to be trading crypto one day, futures the next day, and options the final day. You want to focus on one instrument. Whatever that instrument may be for you, it may be futures, it may be Forex, it may be options, whatever it is for you. When you have all three of these aligned on one specific focus, you get rid of 90% of the noise, which in return saves you 90% of the time that you will spend learning in your trading journey. Lesson number two, trading isn't luck or gambling. And I want to emphasize this point using a simple analogy. If we have a coin, well, that coin has a 50% chance of landing on heads every single time that we flip it. Does this mean after 30 flips of that coin, you can guarantee me with 100% certainty that you will get 15 head flips within those 30 flips? The answer is no, you can't. The reason that is because every flip is an independent event. This means just because the first flip may have given us tails, this doesn't mean that the second flip is going to 100% give us heads, because the last event doesn't affect the following events. With this in mind, you have to understand that trading is the exact same and you need to understand statistics. When we look at trading and someone says, I have a 60% win rate, that doesn't mean that they win 6 out of 10 trades every single time they trade, because that sample size of 10 trades is too small. They may have won 8 trades within the 10, or they may have lost 8 trades out of that 10. It's too small of a sample. However, the more data you have and the longer you trade your system, the more accurate your win rate becomes. So when we have a sample size of 1,000 trades, that will be much closer to a 60% win rate than a sample size of 10 trades, which isn't enough trades. And the problem with traders is if they think that they have a 60% win rate, a 70% win rate, and out of 10 trades, they don't win 60% of the time or 70% of the time, they will simply think the strategy doesn't work and they'll hop to the next strategy. In reality, the sample size simply wasn't big enough. So this also correlates with the last point as well. When you're trading your one system or your one strategy, make sure you have enough data. Make sure you have enough sample size. Don't just look at 10 trades and because they didn't work, you think the strategy doesn't work. In reality, it may be a cycle in the market where that strategy just has a lower win rate. However, you need to test it over a long period of time. Lesson number 3, a consistent trader beats an intelligent trader. Here's the thing. Our job as a trader is not to predict the markets. Our job is simply to react to what the market gives us. And therefore, when you understand that, you understand that every single trade you take has 3 outcomes. You can either win a trade, you can lose a trade, or you can go break even on a trade. But for me, every single time that I would lose a trade, it was extremely difficult to accept the loss. And I know if you're watching this video, you've had this scenario happen as well, where you see a good high quality trade, you enter the trade, and as soon as you enter the trade, it goes to your stop loss. Now, because you think it is a high quality trade, you don't stop yourself out. Even though your original plan was to stop out of the trade, you don't do it because it was a high quality trade. And because of this, now where you should have only lost $100 on your stop loss, you now lost $1,000 because you didn't follow your rule. And you thought you were more smart than the market. So to combat this, you need to understand, if you take a trade and win, you are not smart. If you take a trade and lose, you are not dumb. Everything in trading is independent. Our job is, as a trader, identify a good setup, enter, and then manage risk. That's it. We do not want to predict the market's movements either. We simply enter based off the repeatable patterns that we have, and our only job is to make sure we are minimizing our losses and we are increasing our profits as much as possible. Lesson 4, money management. Now, adding on from the last lesson, like I said, our only job as a trader is to be the best risk manager possible. Problem is, as a new trader, when I started out, the only thing I would think about when I was looking at a trade is how much money could I make if I enter this trade. And contrary to popular belief, this is the worst way to think about trading. I know everyone comes into trading because they want to make money, and therefore it makes logical sense to think about how much money you can make when you're entering a specific trade. But rather, as a professional trader, instead of thinking about how much money you can make, focus on how much money could I lose if I enter the trade. This is the only way to stay in this game long term, and most people who quit trading before seeing any success with it usually quit because they lost all the capital that they were trading with. And in trading, you have to understand, the longer you stay in the game, the better your chances of seeing success as a trader. Trading is a game where the more experience you have under your belt, the better you will start trading, because you will start picking up on patterns that you can use for your statistical edge. However, most people don't get to that point because they want to make money too fast, and therefore they put too much money into the trades they take, and because of that, before actually learning the skill properly, they would have already ran out of money chasing fast profits. Lesson 5, you need to track your trading performance. The reality is your real trading journey doesn't begin until you have a proven system, but building a bulletproof proven system only comes from tracking your performance. Before this, all you're doing is gambling. Your trading is not mechanical. You're simply entering trades in the hope of winning because you have no statistics to back why you're entering that trade. For me, I realized my trading improved 10x the day I implemented tracking my performance. Now, a lot of traders talk about tracking your performance, but they don't tell you why, and they don't tell you the benefits of tracking your performance. So first, let's talk about backtesting. When you're backtesting, you're looking at previous data and you're entering those trades with no risk, but at the same time, you're looking at every single trade where you would have entered, where you would have exited, and at the same time, you're following your plan every single time. So when you backtest over a long period of time and see positive results, you have an increase in confidence and conviction of actually entering your trades. If you're someone that's trigger shy and you simply can't enter trades because you're just nervous of what the result or outcome will be, when you backtest those trades and see the results over hundreds of trades, you know, even if you lose one trade, two trades, or even 10 trades in a row, your system does work in the long run. And that's the beauty of backtesting. You have an increase in confidence and conviction. You can also hold your winners longer because you understand that they will hit your profit target, and therefore when you enter the trade, all you're going to do is let your winner either hit your profit target or stop loss. So the third benefit is you do not prematurely stop yourself out of trades. Sometimes you may enter a trade and it starts consolidating or chopping around in between your stop loss and profit target, and you may become antsy and stop yourself out of the trade because, hey, you're saving money. But what you need to understand is you didn't follow your plan every single time you did that. And therefore, when you look at the backtested proven results, you'll be able to identify those patterns, and backtesting accelerates your experience within your trading journey. Number 2, journaling. When you journal every single trade you have, good or bad, you can start to refine your processes. You can see mistakes that you made that you may have not been able to identify in real time when you're trading because you had too many emotions. And you can find patterns of mistakes that you're making consistently within trades. And when you have all of this data of the trades you've taken and what you've done right and what you've done wrong, you can focus on what you're doing wrong every single time you take a trade, and you will see within your journaling and your results, you will start to get better trade over trade because you're focusing on the mistakes and you're fixing them. But the only way you're even going to be able to find the mistakes is if you have the data to prove it. So that's why it is so important to track your performance as a trader. Lesson number 6, stop living in a fantasy world. Now, I learned this the hard way, and I don't want you to make the same mistakes as me. So take it from me when I say social media shows the highs, but they will never show the lows. When I first started trading, I had such high expectations. I wanted to make $100,000 as fast as possible. I was still younger at the time, so I wanted to buy my first supercar. I wanted to get my dream house and everything that social media portrays that traders live like. But in reality, you have to understand, you're not going to make $100,000 in your first 3 months trading. trading. This is a slow road. Can you make $100,000 in a year? 100%. Can you make $100,000 in a month? Yes. Can you make $100,000 in a day trading? Yes. But the problem is, as a new trader, you know that other people are making a lot of money. And so you will go and try to replicate those profits without learning the skill. And because of that, you will fail time in and time out, and you won't make any money, but rather you will lose money. And therefore, I tell this to everybody who wants to learn trading: before you go and quit your job or make trading your full-time income, do not start spending your trading money. When I made my first $100,000 in a month, if you've watched my story video, I bought my first supercar and started spending my trading money recklessly. But you have to understand, once you start seeing consistency as a trader, withdraw your profits every single month and put them into a saving account or another investment account where you can save all the money that you're making from trading. You should keep your job, and with your trading income, you should build up enough savings where you have 2 years of fully paid expenses for your current lifestyle, and you do not have to rely on trading. Once that is done, and only when that is done, that's when you can start thinking about quitting your job. Anytime before you have that savings lined up and you've shown that you're consistently making money in the markets, do not quit your job. This is going to be a slow road. Even if you've learned all the technicals, the psychological part of trading will take you time to master. And because of this, you don't want to add the pressures of relying on your trading income for your monthly bills on top of that. So we want to make trading as stress-free as possible. And the only way to do this is to have that safety nest. So even if 1 month you don't make money trading, you won't have to rely on your trading income to pay your bills. Lesson number 7, become a never-ending student. You have to understand the markets are constantly changing. Therefore, to keep your edge, you need to keep refining your strategy. Just because your strategy works right now does not mean it's going to work forever. I've seen traders become successful, make 6 figures, but because they stop refining their system and become lazy, I've also seen those same people lose money because they thought they were smarter than the market. Therefore, if you really want to become a profitable, consistent trader for the long run, you need to be able to learn and identify the weak points of your strategy based off of different market conditions. You need to be constantly learning and mitigating your emotions. As a trader, you will never get rid of them, but it is our job to always make sure that our emotions do not come in front of our judgments when we're trying to take a trade. And finally, it may be a downturn for your strategy, but that does not mean you have to change your strategy. It simply means you have to refine it for the specific market. So don't misinterpret this last lesson as if your strategy stops working, you change it. No, you simply look at the market and see why it's not working. And 90% of the time, it's going to be a small tweak in your strategy based on the specific market that will make it profitable again. And at the end of the day, you have to remember, the more you learn about yourself, the better trader you will become, because you can handle different situations much better knowing the person you are. Now, like I said earlier in the video, I want to make sure that you have actionable steps that you can implement in 2025 to actually become a profitable trader. So if you want to learn the exact framework to trade with, the steps to take from beginning to end to become a profitable trader, and the best plan for profitability in 2025, in this video, we went over exactly how to start day trading. You have now completed the full course from A to Z on what you need to learn to become a day trader. Now, becoming a day trader is a long journey. If you'd like more education from me and a like-minded community of traders where I personally live trade every single day, and we have a very strong community of traders that are learning to trade the right way with the right expectations, make sure to check out the Accelerator. It's a more in-depth trading community with myself where I actually trade live every day, so you can see how I implement these lessons in real time when the market is open. Other than that, I hope you got some value from this video. If you want to learn more about technical analysis, psychology, strategy, and system, make sure to click the playlist on screen now. It is filled with hours of free trading content. If this video did help you, make sure to leave it a like. If you have any questions, put them in the comments down below. Make sure to subscribe to the channel, follow me on Instagram and Twitter for more education, and I will see you next week with a brand new video.